Welcome in. Your investment returns are directly tied to the behavior that you engage in with your portfolio. Most investment mistakes are behavioral, and avoiding those mistakes and understanding how to evaluate your portfolio will go a long ways in growing your wealth and helping you compound wealth over the coming decades. Let's talk about three different mistakes that I've seen from my time running Brownlee Wealth Management. And before I started this firm, I worked at a very large brokerage firm, one of the largest 401k providers, in addition to just one of the largest asset managers in the world. And I saw something constantly through clients that would come in wanting a second opinion on their portfolio. So the biggest mistakes that I see whenever a family or individual is evaluating how their portfolio is performing, most of it has to do with focusing on past performance. But I want to get a little bit more specific and talk about three ideas. Let's dive in. All right, comparing apples to oranges. Comparing apples to oranges, quick idea here is it is really tempting to simply look at 3-year, 5-year, 10-year returns in a portfolio. Maybe you're looking at a list of mutual funds or a list of stocks, ETFs, whatever it may be. Something similar to this. I'm sure you've all seen a picture like this, especially in a 401k lineup. But you might have a list of funds, and sure, I'm sure that you do pay attention to who is the manager. I don't doubt that you're looking at the expense ratio to understand what fees are you going to be paying. Morningstar rating, very popular to look at those. But a lot of your attention, it's hard to look past the return numbers. What happened in the past 3 years, 5 years, 10 years? What are the performance numbers year to date? So those are the questions that get asked. Now, the difficulty with that is whenever you're looking at performance, you're inevitably going to say, okay, large growth. Well, that's done really well over this decade. So in this article that I wrote, and we can have a link to that, and you can take a look at our article section to find that. I actually picked a sample fund. So I picked a random fund company, picked their US large cap fund, and similar to this picture, I didn't plan this, but it happened to be a 14% return over the past 10 years. And in the article, I dive into the fact that that's not a good return. Now, when you're looking at a list of mutual funds, and you might see, well, oh my goodness, the large cap international or international did 8.5%. Value stocks did 8% here, mid cap. So that includes some small cap, small value here. Those only did 10%. Well, 14% is a really good fund. And I explained in the article that 14% is not a good return. The fund that I picked as an example in my article, a few really big problems, three big problems with that fund. One, the index did 16%. So if a fund does 14%, it's easy to say, well, this 14% fund is so much better than this other fund that only made 9%. But that's comparing apples to oranges if you're comparing a US large cap fund to an emerging markets fund, which is really in the picture I just showed and the example in my article. That's what's happening. It's not that this was a good fund. It's that US large caps happen to do a lot better than emerging markets. They happen to do a lot better than small caps, and they happen to do a lot better than developed international markets. And remember, past performance, as the famous saying goes, past performance is not indicative of future performance. Past performance is not a guarantee. It's not even shedding light on what future performance could be. So whenever you look at a fund and maybe it's had great performance and you're wondering, well, why would I take some of my money and put it in something that's made 9%? Well, the question is, should you put all of your money in US large caps? Why? If that's the conclusion you're coming to, why should US large caps have all of your money? If it's because they happen to make 16% over the past 10 years, are you expecting that to continue? Do you think that the next 10 years are going to be another 16% annualized return decade? It's possible, but it's not likely. And if the answer is, well, we can't put any of our money in a 9% fund, it's got to be a bad fund. Well, if it made 9% because emerging markets made 9%, you're saying that your portfolio should not have any exposure to emerging markets. Take that same comparison to international developed. Maybe international developed made 10%, maybe it made 6%, but whatever it is, it made a lot less than 14 or 16%. And then the argument becomes, so you're saying that your portfolio should not have any exposure. to developed international companies. And I would find significant faults with that. Remember, past performance not indicative of future performance, future returns. And also, we have to remember when you're comparing apples to oranges, and in my article, I really go in depth to that 14% fund. Well, the index did 16%, so that's not very good. The expense ratio was about 12 times higher than an S&P 500 index fund, so that's not good. And the turnover rate, which creates a huge tax bill, was also really high. And so if you compare apples to oranges, that 14% fund is a really good fund. If you're comparing apples to apples, it's not a good fund. Second point, evaluating performance over a short period of time. So this is another mistake that happens when you look at your portfolio. And I think this next picture is one that every investor should look at. Every investor should really memorize this. It's the periodic table of returns from Callan. So it's returns from 2001 to 2020. Over this 20-year period, you'll notice that it ranks every part of the market: US bonds, high yield bonds, cash, small caps, large caps, emerging markets, developed international markets. It even has real estate in there. And for over this 20-year period, it's telling you, well, what did the best and what did the worst? And the key thing that I want you to take away from this picture is that there is not a silver bullet. It is not possible to pick one part of the market and have great returns and avoid volatility. So if you want to avoid volatility, well, you're going to put more money in bonds and cash. And then for the past 10 years, you're not going to do nearly as well, and you're going to miss out on enormous opportunity to grow your wealth. But even within the stock market, just to that last point, it's so tempting when you see a 14% or 16% return over a 10-year period. You want to put everything there. And how could you ever justify putting something in a lesser returning fund? But as this graph shows, if something struggles for several years, it's probably at a much better valuation and a much higher chance that that the next 5 years, next 10 years, it could really take off. And then the other thing to point out, five-star funds. So I brought up Morningstar rankings, Morningstar ratings. What's fascinating about mutual fund ratings, the mutual funds or ETFs that operate, that give you the performance in the top quartile, over the next 5 years, the vast majority of them did not maintain that high performance. Vast majority of funds that are 5 stars do not maintain their 5-star performance. So very, very common to see a fund or a ETF or a mutual fund or a stock even as well that has a great performance for a period of time, but that's not a guarantee that that exact security is going to continue over the next 10 years. And so evaluating performance over short periods of time, that is a problem. Last point, misreading volatility. And so whenever you're evaluating your portfolio and you see that a part of the market hasn't done well, the question is, do you need to make a change, or are you in an excellent fund, excellent strategy, your portfolio's fine, and it just happens to be a volatile period and you're underperforming? But that's okay, just stick with it. And over the long haul, you'll be in a good spot. So that's a tough question to answer. This is by far the hardest point of all of them because you're going to have periods when your portfolio is underperforming other investments. And the question is, do you need to make a change, or is your portfolio just going through a period of underperformance, as they all do? And in our portfolios, we talk about this on the Investment Manifesto podcast, but we like to have a globally diversified, low cost portfolio that slightly tilts towards factors in the markets that have historically led to better performance. And those factors are small caps have done better than large caps, value stocks have done better than growth stocks, and profitability. Profitable companies have done better than their less profitable peers. So in essence, if you could build an index portfolio diversified around the whole globe, but then slightly tilt towards a little bit more small companies, a little bit more value companies, and a little bit more in the profitability factor, you give yourself an excellent, historically and academically, there's a good reason to believe that you give yourself a great portfolio that should compound your wealth at a tremendous rate. Now, these are the historical facts around those factors that, as you can see here, there's a lot going on in this picture, but main thing to focus on within the US, within international, within emerging markets, small has done better than large. Value has done better than growth. Profitable companies have done better than their less profitable peers. But over the past 10 years, This just hasn't been the case. Two of those three factors have severely underperformed. Small has not kept up with large cap. Value has done substantially worse than growth. Profitability has held up well. But two of these three have not done very well. So it's easy to look at your portfolio and wonder, well, are we in a bad period, or is something wrong and do we need to ditch it and make a complete change? And another example of this, the difficulty with volatility. Let's say that you did think that, or you were just looking to put a portion of your money in U.S. large companies, and you've probably heard that Warren Buffett's an incredible investor. Berkshire Hathaway has been an incredible stock. Since Warren Buffett took over, Berkshire Hathaway has just had incredible performance, significantly better than the S&P 500. But take a look at this next picture. Warren Buffett and Berkshire Hathaway, all throughout his tenure, all throughout the last 50, 60 years, we have seen periods, we've seen years scattered throughout, not scattered all in one spot, but throughout the last 5 or 6 decades, we've seen underperformance. And still, Warren Buffett is better. Berkshire Hathaway is better than the S&P 500. So the last point and the last mistake to avoid is understanding when your portfolio underperforms, is it because it's a bad portfolio, or is it a great portfolio and it just happens to be in a period of underperformance? And so that can be a really difficult question to ask and answer. And these points, getting them right, are going to make you a better investor and help you better evaluate. Is your portfolio in a good spot? Does your portfolio need a change? Is your portfolio's performance reasonable? Is it good? Is it bad? And if it's good or bad, do you need to make a change or not? And so it's not black and white. And we look forward to putting out more questions and content like this.